What I'm about to show you is happening right now at the COMEX, and if my calculations are correct, we're looking at the last realistic window for silver accumulation before a price event that could send silver from today's $30 range to $250 or higher. And I'm going to walk you through the exact math that points to this scenario. Now, before you click away, thinking this is just another outrageous prediction, I need you to understand something. This isn't based on hope, hype, or speculation. This is based on publicly available COMEX data, supply-demand mathematics, and a structural problem in the silver market that's been building for decades and is now reaching a critical breaking point. Welcome to Finance Monopoly, where we break down the financial analysis that mainstream media won't touch and the mathematical realities that most investors are completely ignoring. On this channel, we don't do surface-level price predictions or clickbait guesses. We do deep-dive quantitative analysis on alternative assets, precious metals, and strategies that can actually build and preserve wealth in an increasingly unstable financial system. If you're new here, hit that subscribe button and turn on notifications, because we're publishing detailed financial analysis multiple times per week, and you don't want to miss the data that could completely change your investment strategy. Today, we're going to answer 3 critical questions. Number 1, what is actually happening at the COMEX right now that could trigger a massive silver price spike? Number 2, what is the mathematical path from $30 silver to $250 silver, and what needs to happen for that scenario to play out? And number 3, how much time do we actually have before this window closes? By the end of this video, you'll have the complete framework, the actual numbers, and the timeline for what could be the biggest silver price event in modern history. So let's get straight into the data. First, let's establish what we're talking about. The COMEX, the commodity exchange, is the primary marketplace where silver futures contracts are traded. Now, here's what most people don't understand. The COMEX operates on a fractional reserve system, meaning they trade far more silver on paper than actually exists in their physical vaults. Think of it like a bank. If a bank has $1 million in actual cash, but has issued deposit claims for $100 million, they're operating on a 100-to-1 fractional reserve ratio. They're fine as long as everyone doesn't show up asking for their money at the same time. But what happens when they do? Bank run, collapse, panic. The COMEX operates on a similar principle with silver, except the ratios are even more extreme. And right now, we're seeing early warning signs that this system is beginning to crack. Let me give you the current numbers, and I want you to pay close attention because this is where the math gets really interesting. As of the most recent report, total COMEX registered silver sits at approximately 40 to 50 million ounces. This fluctuates, but let's use 45 million as our baseline. Total open interest in silver futures is approximately 140,000 to 150,000 contracts, and each contract represents 5,000 ounces of silver. Do the math with me. 145,000 contracts times 5,000 ounces equals 725 million ounces of silver in paper claims. 725 million ounces in paper claims versus 45 million ounces in registered physical inventory. That's a ratio of approximately 16 to 1. 16 paper claims for every 1 physical ounce actually sitting in COMEX vaults. Now, here's where this gets critical. Historically, only about 1 to 3% of futures contracts actually demand physical delivery. Most are cash settled or rolled over into new contracts. The COMEX system is built on this assumption. And as long as 97 to 99% of contracts settle in cash, the system works fine. But we're starting to see something very unusual happening. Delivery requests are increasing, not dramatically yet, but consistently. We're seeing major buyers, institutions, foreign governments, high net worth individuals actually standing for delivery instead of taking cash settlement. In recent months, delivery percentages have risen from the historical 1 to 2% range to 3 to 5% in certain contract months. That might not sound like much, but let me show you what happens if this trend continues. If delivery requests increase from 2% to just 10% of open interest, we're talking about 145,000 contracts times 10%, which equals 14,500 contracts demanding delivery. 14,500 contracts times 5,000 ounces equals 72.5 million ounces demanded. But remember, the COMEX only has 45 million ounces in registered inventory available for delivery. That's a shortfall of 27.5 million ounces. And that's at just 10% delivery requests. What happens if it goes to 15%? 20%? What happens if even a fraction of the 16 to 1 paper to physical ratio actually demands their metal? This is the structural problem that could trigger a price event unlike anything we've seen in the silver market. And this is just part 1 of the equation. Now let's zoom out from the COMEX and look at the bigger picture of silver supply and demand. Because what's happening at the COMEX is happening against a backdrop of a global silver market that's already in deficit. Global silver mine production has been essentially flat to declining for the past several years. We're producing approximately 820 to 850 million ounces of silver per year from mining. Add in recycling, approximately 170 to 180 million ounces per year. And we have a total supply of roughly 1 billion ounces annually. Now, here's the critical number, that production has peaked. We're not finding major new silver deposits. Existing mines are depleting. And this is important. Approximately 70% of silver is produced as a byproduct of mining other metals like copper, zinc, and lead. What does that mean? It means silver production is largely dependent on the economics of other metals. Even if silver prices rise, we can't just produce more silver without the economics of copper or zinc mining also making sense. Supply is relatively inelastic. Remember this, because it's crucial to our $250 price target. When demand surges, supply cannot quickly respond. This is the setup for explosive price action. Now, let's talk about the demand side, and this is where things get really interesting. Silver isn't just a monetary metal or an investment vehicle, it's an industrial commodity with applications in solar panels, which consume 100 to 120 million ounces annually. And growing, electronics, where every smartphone, computer, and electric vehicle has silver, medical applications due to its antibacterial properties, 5G infrastructure with massive silver requirements, electric vehicles which use 2 to 3 times more silver than traditional vehicles, and green energy technologies across the board. Current industrial demand sits at approximately 510 to 530 million ounces per year. But here's the exponential factor. The solar industry alone is projected to grow by 15 to 20% annually for the next decade. Electric vehicle adoption is accelerating globally. 5G infrastructure build-out is just beginning. Conservative estimates suggest industrial demand could increase by 150 to 200 million ounces over the next 5 to 7 years. And remember, this demand is inelastic. Manufacturers can't just substitute another metal. Silver's properties are unique for these applications. Then we have investment demand, and this is the wild card that could trigger our $250 scenario. Current investment demand from coins, bars, and ETFs runs approximately 200 to 250 million ounces annually. But this number can explode during precious metals bull markets. Let me give you historical context. In 2011, during the last major silver bull run, investment demand spiked to over 300 million ounces. Silver went from around $18 to $48 in a matter of months. That's a 165% gain. But here's the difference between then and now. In 2011, total global debt was around $150 trillion. Money printing was a new emergency measure, industrial demand was lower, and there was no major supply deficit. Today, in 2024, total global debt is over $300 trillion. Money printing is normalized and ongoing. Industrial demand is at all-time highs and growing, and we're running supply deficits. According to the Silver Institute, the global silver market ran a deficit of approximately 200 million ounces last year. That means demand exceeded supply by 200 million ounces, and that gap was filled by above-ground inventory that's steadily shrinking. So let's do the math. Annual supply is roughly 1,000 million ounces. Industrial demand is approximately 520 million ounces. Investment demand currently sits at about 230 million ounces. Total demand equals 750 million ounces. That leaves approximately 250 million ounces for additional investment demand before we hit a hard supply wall. Now, what happens if, during a financial crisis, inflation spike, or banking panic, investment demand doubles from 230 million to 460 million ounces? We'd have a shortage of 210 million ounces per year with no way to quickly increase supply. Price would have to rise dramatically to ration available supply. And that's exactly how we get to $250. All right, now let's build the mathematical framework for a $250 silver price. I'm going to show you 3 different approaches, and you'll see that $250 isn't just possible. It's actually conservative under certain scenarios. First, let's establish our baseline. Silver is currently trading around $30 per ounce. To reach $250, we're looking at an 8.3 times increase, or a gain of approximately 733%. Now, before you dismiss that as impossible, let me remind you, 1979 to 1980, silver went from $6 to $50. A 733% gain in 12 months. 2008 to 2011, silver went from $9 to $48, a 433% gain. These massive moves are not unprecedented in silver. What's different this time is we have fundamental supply-demand dynamics that support sustained higher prices, not just speculative mania. Mathematical approach number 1, the supply deficit model. Let's say investment demand increases by 100% from current levels, from 230 million ounces to 460 million ounces. This is what happened during previous precious metals bull markets, so it's not an extreme assumption. New total demand would be industrial at 520 million plus investment at 460 million, totaling 980 million ounces. Annual supply is 1,000 million ounces. We're not quite in deficit yet, but we're using 98% of total supply with zero buffer. But now factor in industrial demand growth of 50 million ounces over the next 2 years from solar and electric vehicles, any supply disruption from mine closures or geopolitical issues, and COMEX delivery demands removing metal from available supply. We quickly move into a 100 to 200 million ounce annual deficit. Historical data shows that when silver markets run into supply constraints, price elasticity is extreme. A 10% supply shortage can lead to 50 to 100% price increases as the market scrambles for available metal. A sustained 15 to 20% supply shortage, that's when you see price multiples of 3 times, 5 times, even 10 times. Using a conservative elasticity model, a 15% supply deficit equals a 3 to 4 times price multiplier. Current price of $30 times 4 equals $120 to $150 baseline. But that's just to clear the market under normal conditions. If we add panic buying, COMEX stress, or allocation concerns, we easily see spikes to the $200 to $300 range before supply-demand reaches equilibrium. Mathematical approach number 2, gold-silver ratio reversion. The current gold to silver ratio sits around 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged much lower. The historical average is 50 to 60 to 1. During bull markets, it's been 30 to 40 to 1. Natural occurrence in Earth's crust is 15 to 17 to 1. Let's run some scenarios. If gold is trading at $2,500 per ounce at a 50 to 1 ratio, we get $2,500 divided by 50, which equals $50 silver. At a 40 to 1 ratio during a bull market, $2,500 divided by 40 equals $62.50 silver. At a 30 to 1 ratio during an extreme bull market, $2,500 divided by 30 equals 83 post 33 silver. But here's where it gets interesting. What if gold doesn't stay at $2,500? Many analysts, including institutions like Goldman Sachs and Bank of America, have projected gold could reach $3,000 to $4,000 in the next major monetary crisis. If gold reaches $3,500 and the gold-silver ratio reverts to even 40 to 1, we get $3,500 divided by 40, which equals $87.50 silver. At a 30 to 1 ratio, $3,500 divided by 30 equals $116.67 silver. Now, in extreme scenarios, if gold spikes to $5,000, which it did in inflation-adjusted terms in 1980, and silver reverts to a 20 to 1 ratio, which has happened historically, we get $5,000 divided by 20, which equals $250 silver. There's your $250 mathematical path via ratio reversion. Not speculation, mathematical reversion to historical norms during a precious metals bull market. Mathematical approach number 3, inflation-adjusted historical high. Silver's nominal all-time high was $48.70 in January 1980 and again briefly in 2011. But here's what nobody talks about. Adjusted for official inflation, that 1980 high would be approximately $165 to $180 today. And that's using official CPI numbers, which many economists argue significantly understate true inflation. If you use alternative inflation measures like shadow stats or the methodology used in the 1980s, 1980's $50 silver equals $400 to $600 in today's purchasing power. Now, I'm not saying silver has to reach its inflation-adjusted all-time high, but $250 would only be 1.5 times the conservative inflation-adjusted high, or 0.6 times the alternative inflation-adjusted high. In other words, $250 silver would still be cheaper than 1980's peak in real inflation-adjusted terms. From a historical valuation perspective, $250 isn't extreme. It's actually conservative if we're entering a true precious metals bull market comparable to the 1970s. So now we have 3 independent mathematical frameworks all pointing to $250 plus silver being not just possible, but probable under the right conditions. Supply deficit model points to $200 to $300 range. Gold-silver ratio reversion gives us $250 at gold $5,000 and a 20 to 1 ratio. Inflation-adjusted historical high shows $250 is conservative. The math checks out. Now let's talk about timing. So why am I calling this the last window for silver accumulation at these prices? Because several critical factors are converging in the next 12 to 24 months. Factor 1, COMEX stress points. The COMEX delivery requests are trending upward. Major players are figuring out that they can pressure the system by demanding physical delivery. As this becomes more widely known and practiced, we could see a cascading effect where everyone rushes to convert paper to physical before the system breaks. Once that happens, once there's a genuine delivery failure or force majeure declaration at the COMEX, silver prices will gap up instantly. You won't be able to accumulate at $30, $40, or even $50. The reset will be swift and dramatic. Factor 2, industrial demand acceleration. Solar panel manufacturing is scaling exponentially. The IEA project's solar capacity will triple by 2027. Electric vehicle adoption is accelerating with government mandates kicking in globally. 5G infrastructure is moving from planning to implementation. This industrial demand is locked in. It's not price sensitive in the short term. Manufacturers will pay $40, $50, $60 for silver because it's a tiny component of total product cost. As this demand ramps up over the next 2 to 3 years, available supply for investment will shrink dramatically. Right now, there's approximately 200 to 250 million ounces available for investment annually. In 3 years, with industrial demand growth, that could shrink to 100 to 150 million ounces. Less available supply, plus same or higher investment demand, equals significantly higher prices. Factor 3, monetary crisis probability. Global debt levels are at all-time highs. We've seen banking stress in 2023 with Silicon Valley Bank, Signature Bank, Credit Suisse. Central banks are trapped between inflation and recession. The probability of a major monetary event, whether banking crisis, debt crisis, or currency crisis, in the next 1 to 3 years is significant. When that happens, precious metals will be the refuge. And silver, as the poor man's gold, will see explosive investment demand. But you can't wait until the crisis hits. By then, premiums will be 30 to 50% over spot, dealers will be out of stock, and prices will already be multiples higher. So what's the actual timeline we're looking at? Phase 1 is the accumulation window, which is now through the next 12 months. This is where we are now. Silver between $25 and $35 available for purchase at reasonable premiums. COMEX stress building but not critical. Most investors still ignoring silver. This is your window to accumulate physical metal, mining stocks, and strategic positions. Phase 2 is the recognition phase, 12 to 24 months out. COMEX delivery issues make headlines. Supply deficit becomes mainstream news. Industrial buyers compete more aggressively for supply. Investment demand starts accelerating. Silver breaks through $50 to $60. Premiums start expanding. Availability becomes more constrained. Phase 3 is the mania phase, 24 to 36 months out. This is where we see potential $100 to $250 scenarios. Widespread recognition that silver is in structural deficit. COMEX potentially restructures or faces delivery failures. Gold in full bull market pulling silver with it. Retail investors pile in too late. Media finally covers silver. Governments possibly intervene or change regulations. Now, I'm not saying you can perfectly time these phases. Markets don't move in straight lines. There will be volatility, pullbacks, and false starts. But what I am saying is this: the current setup is extraordinarily favorable for a major silver price move, and the risk reward at current prices is asymmetric. If I'm wrong and silver stays at $30 to $40 for years, your downside is limited. Silver has industrial demand, monetary properties, and 5,000 years of history as money. It's not going to zero. But if I'm right, if even half of what I've shown you plays out, your upside is 5 times, 8 times, potentially 10 times returns. That's the definition of asymmetric risk reward. That's the opportunity in front of you right now. Now, before we wrap up, I need to give you the reality check, because unlike most channels that only show you the bull case, here at Finance Monopoly, we give you the complete picture. What could prevent $250 silver? Risk number 1, economic collapse. If we get a severe global depression with massive demand destruction, industrial demand for silver could temporarily collapse. In a deflationary crash, even precious metals can initially decline as everything gets sold for cash. This would likely be temporary, as monetary response would be massive, but it's a risk to consider. Risk number 2, technology substitution. If a major breakthrough allows manufacturers to substitute silver with a cheaper alternative in key applications like solar and electronics, industrial demand could decline. I view this as low probability in the near term. Silver's properties are unique, but it's theoretically possible. Risk number 3, massive new supply discovery. If an enormous new silver deposit were discovered and brought online quickly, it could alleviate supply concerns. Again, low probability, given geological realities, and the time required to develop mines, but it's possible. Risk number 4, government intervention. Governments have historically intervened in precious metals markets. See 1933, gold confiscation, and various export restrictions. If silver becomes strategically critical for green energy, governments might intervene through export controls, windfall taxes, or even restrictions on private ownership. Risk number 5, extended timeline. The biggest risk isn't that this doesn't happen, it's that it takes longer than expected. Markets can remain irrational longer than you can remain solvent. Silver could consolidate at $30 to $40 for another 2 to 3 years before the real move begins. If you're over-leveraged or using short-term options, you could be right about the direction but wrong on timing and still lose money. This is why position sizing matters. This is why we don't bet the farm on any single scenario. This is why we build positions gradually and manage risk intelligently. So what should you actually do with this information? Step 1, do your own research. Don't just trust me or any other YouTube channel. Verify the COMEX data yourself. Look at the Silver Institute reports. Study the supply-demand fundamentals. Make your own informed decision. Step 2, determine your position size. If you believe in this thesis, what percentage of your portfolio does it warrant? For most people, 5 to 15% in precious metals is reasonable. More aggressive investors might go 20 to 30%, but never more than you can afford to have tied up for potentially several years. Step 3, decide physical versus paper. Physical silver, coins, and bars gives you real ownership, but comes with storage and liquidity considerations. ETFs and mining stocks give you price exposure with liquidity, but come with counterparty risk, and don't protect against system failures. Most balanced approaches include both. Step 4, build gradually. Don't try to time the perfect entry. If you believe in the multi-year thesis, build your position over 3 to 6 months through dollar cost averaging. This reduces timing risk and gives you better average pricing. Step 5, plan your exit. Before you buy, know under what conditions you'll sell. Is it a price target, a ratio reversion, a timeline, a fundamental change in the thesis? Having an exit plan prevents emotional decision-making later. Let's bring this all together. We've covered the COMEX math showing a 16-to-1 paper-to-physical ratio that's vulnerable to delivery demands, the supply-demand fundamentals showing flat production, growing industrial demand, and potential investment surge creating structural deficits. 3 mathematical frameworks, all pointing to $250 plus silver as reasonable under bull market conditions. Supply deficit model gives us $200 to $300. Gold-silver ratio reversion gives us $250. Inflation-adjusted historical high ranges from $165 to $600. The timeline suggesting we're in a 12-month accumulation window before Phase 2 recognition begins. And the risks including economic collapse, technology substitution, extended timelines, and government intervention. The bottom line is this. We are potentially looking at one of the greatest asymmetric opportunities in the precious metals market in decades. The mathematical setup is clear. The COMEX stress is real. The supply-demand fundamentals are tightening. $250 silver isn't guaranteed, but it's absolutely possible. And under certain scenarios, even conservative. The question isn't whether silver will eventually reprice significantly higher. The question is, will you position yourself during the window when most people are still ignoring it? Or will you wait until it's obvious to everyone and the easy gains are already gone? If you found this analysis valuable, here's what I need you to do. First, smash that subscribe button and turn on all notifications. We're publishing in-depth financial analysis like this multiple times per week at Finance Monopoly, covering precious metals, alternative investments, and strategies the mainstream won't show you. Second, hit the like button. It tells YouTube to show this video to more people who need to see this analysis, and it helps us continue producing this level of content for you. Third, drop a comment below telling me, do you think silver reaches $250? What's your timeline expectation? What percentage of your portfolio are you allocating to silver? I read every comment, and I'll respond to as many as I can. Fourth, check out the other videos on this channel where we break down the best ways to buy physical silver without getting ripped off, top silver mining stocks positioned for explosive gains, and how to structure a precious metals portfolio for maximum returns. Remember, at Finance Monopoly, we break the monopoly of information. We give you the data, the analysis, and the frameworks to make informed investment decisions. The window is open, the math is clear, the opportunity is in front of you. What you do next is up to you. I'll see you in the next video.